We talk about artificial intelligence like it lives in the ether, a weightless network of code. But the reality is industrial. This chart shows a projected $8.2 trillion global investment to add 200 gigawatts of data center capacity by 2032. For context, that footprint exceeds the total economic impact of building the U.S. interstate highway system. This is a return to the railroad era, a massive mobilization of labor and raw materials to lay the physical foundation for a new economy. Progress now hinges on the power grid. Algorithms are taking a back seat to the physical availability of copper, concrete, and high-voltage transmission. The limit to how smart an AI can get is becoming a question of thermodynamics and physical space. The battle is moving from the screen to the construction site. To understand why these requirements are so intense, we have to look at the hardware. Training a modern AI model requires thousands of specialized graphics processing units, or GPUs, packed shoulder to shoulder inside a server rack. A traditional cloud server rack draws roughly 5 to 10 kilowatts of power. A modern AI rack populating high-end accelerators can pull over 120 kilowatts. Pulling that much electricity into a space the size of a refrigerator generates an immense volume of heat. Air conditioning systems cannot move air fast enough to stop the silicon chips from melting. Facilities must install direct-to-chip liquid cooling or closed-loop refrigerant systems just to keep the machines operational. At this level, heat and power density dictate what a data center can actually accomplish. Now scale that single rack up to a contemporary hyperscale campus. A 200-megawatt data center holds roughly 2,000 of these setups operating simultaneously. That single campus draws as much continuous electricity as 200,000 U.S. homes. Constructing a single 200-megawatt facility costs roughly $8.2 billion. As shown, $5.6 billion, nearly 70%, is spent exclusively on specialized IT hardware. The economic weight has shifted inside the walls. Most capital is concentrated in silicon rather than the building itself. Industry leaders are pushing past this scale. OpenAI and NVIDIA recently announced a partnership to deploy 10 gigawatts of AI systems over coming years. These physical requirements are so extreme that the tech sector can no longer fund them using cash reserves. They are turning to complex external debt. The physical scale of AI has forced the tech industry to rewrite how it finances its operations. Companies like Meta and Microsoft are valued as asset-light software businesses. Putting tens of billions of dollars of concrete and servers directly on their balance sheets risks damaging their credit ratings and stock valuations. To avoid this, they route the financing through off-balance sheet special-purpose vehicles. This allows private credit markets and external investors to shoulder the debt. In one recent project, the tech giant effectively leased the facility, while these bankruptcy-remote entities absorbed $27 billion in external debt. This shadow architecture allows tech firms to maintain their equity valuations while quietly injecting enormous amounts of leverage into the industry. As this leverage piles up, a vulnerability is emerging at the top of the capital stack: circular financing. The market saw a jarring example of this when NVIDIA discussed a $250 billion financing guarantee to help OpenAI build a massive data center. This flowchart demonstrates the logic. A supplier uses its own balance sheet to guarantee loans for a customer, specifically so that customer has the cash to buy more of the supplier's hardware. During the 1990s telecom boom, Lucent Technologies lent billions to startups so they could buy Lucent's networking equipment. When the startups failed, Lucent was left holding the bad debt. This arrangement requires continuous market hype and uninterrupted demand. If any part of that chain falters, the physical debt remains. The AI industry is building a trillion-dollar empire on a leveraged foundation. If demand for compute shifts or interest rates rise, the weight of those physical assets could quickly overwhelm the financial structures holding them up.